Hello everyone. Today, in just 3 minutes, let's understand ETFs. Imagine you want to achieve the same returns as the S&P 500 index. How would you do it? Buying all 500 stocks, one by one, is hardly practical. But what if there were a product that packaged all those stocks together in the same proportions? By buying just one share, you'd effectively own the entire index. That's exactly what an ETF is. Most ETFs on the market are passive investments. They track an index or a specific theme without relying on subjective stock-picking decisions. Of course, actively managed ETFs also exist, but they are far less common. The benefits of ETFs are straightforward. First, diversification. A single ETF may contain dozens or even hundreds of stocks, so the poor performance of one company is less likely to drag down the entire portfolio. Second, lower costs. Traditional actively managed funds may charge annual management fees of around 1.5%, while ETFs often charge just 0.5% or even less. Third, trading flexibility. ETFs can be bought and sold throughout the trading day, just like stocks, unlike traditional mutual funds that can only be redeemed after the market closes. More importantly, most individual investors find it difficult to consistently outperform the market. For example, investor A invests $10,000 and trades stocks on his own. After a year of frequent trading, he spends $200 on transaction costs. Poor timing and stock selection mean that even though the market rises 10%, he earns only $300. Investor B also invests $10,000, but buys an S&P 500 ETF. With an annual management fee of just $50, when the market gains 10%, he earns approximately $1,000 along with it. Without watching the market every day, Investor B ends up with a better result. That's one reason ETFs have become increasingly popular. Of course, ETFs also carry risks. Since they track an index, they will generally decline when the index falls. If the overall market performs poorly, ETF investors can still experience losses. In addition, less popular ETFs with low trading volume may be harder to buy or sell efficiently, so it's a good idea to check the average daily trading volume before investing. To sum up, ETFs are designed to provide market-level returns in the simplest possible way. They are not a get-rich-quick tool, but they may be one of the safest first steps for ordinary investors entering the world of investing.